In this video, we take an in-depth look at what investors can expect from the market, and index funds in particular, in light of the ongoing Ukraine war. Mutual funds, or ETFs, are often safer options for long-term investors. The S&P 500 has experienced turbulence recently, and as a market trend identifier, this volatility is an obvious concern. Should we be worried about the future performance of index funds in this current climate? Finance experts at Dow Jones, JP Morgan, and Forbes indicate that there are a number of potential risks in the market right now, but this isn't necessarily fatal. For every risk, there is a potential reward, and index funds offer a robust, resilient investment option for those willing to take a gamble on long-term gains. This video lays out the potential pitfalls in the market, the historic trends associated with conflict, crisis, and market identifiers like the S&P 500, as well as some probable trends in 2023. The data suggests surprising outcomes despite the fearful climate around the global economy right now. The real question for many investors is whether or not they should change their strategy as the war in Ukraine compounds inflation, increased cost of living, and market volatility. Let us know if you intend to stick to your current strategy or change things in the comment section below. Will you take a risk on losses in order to benefit from future recovery? Remember to hit like and subscribe to get real-time updates on new finance advice and content that is tailored for the savvy investor. The war in Ukraine has impacted every facet of daily life across Europe. While the USA has been insulated from the worst of it so far, the risk for the market rises as the conflict drags on. Since Russia invaded Ukraine, the world market has experienced record-breaking volatility, even within some of the most established index funds. Understanding what could come next and how to fortify your portfolio against instability is important for savvy investors. This video is going to break down what the past can teach us about the reaction of index funds to war and what the experts say you can expect from 2023. What are index funds, and how does international conflict impact them? If you're already a savvy investor, you're probably aware of the nature and benefits associated with index funds. For the new investors among us and those wondering how to fortify their portfolio, however, an index fund is a diverse collection of assets. You might also hear these referred to as mutual funds or exchange-traded funds, ETFs. These funds are made to match or track the market index, provide balanced market exposure, and a level of protection from market volatility. The most obvious example is, of course, the S&P 500. This fund is generally considered the ideal investment for retirement accounts and traders with a low-risk threshold. But no investment is bulletproof. Macroeconomic issues and geopolitical instability can and will impact them. Historically, however, this kind of volatility is short-lived and the potential for profit after a conflict is surprisingly high. Since 1941, there have been 12 major crises in the market, not counting the current war in Ukraine, related to geopolitical tensions and conflicts. Truist IAG collected data about the historic performance of the S&P 500 after a crisis. This data shows the impact of these crises at the 1, 3, 6, and 12-month points. What may surprise you is that all but 3 of these crises, notably the Suez Canal crisis in 1956, the Arab oil embargo in 1973, and the attack of 9/11 in 2001, show improvement after 12 months. Of course, this is just one index fund, but we're using it as an example because the S&P 500 is widely considered to be a market indicator. This data looks great at the surface level, but we need to keep in mind that this data was impacted by the lost decade, which was more like a lost 20 years. This refers to the period between the Great Depression in 1929 and the next real stock market boom in 1951. So, for many of these crises, the market was already at a low ebb. The real question is, coming from the economic instability of the COVID-19 pandemic, with high rates of inflation, restricted interest rates from central banks, and now the cost of living crisis across Europe, how will the market, and particularly index funds, react? Are index or mutual funds a safer choice than stocks? Now, it's perfectly sensible to wonder if index funds are really the safe choice they seem to be in this market. The answer is that it depends on your risk tolerance. There is certainly a higher risk of short-term volatility right now, and individual stocks are often the most exposed to this. Timing the market in times of high volatility is challenging, nearly impossible many say, but when there are exaggerated risks, there are also higher possible rewards. For example, oil and gas stocks saw dramatic, exaggerated even, rises in 2022 as the increased energy cost pushed the market up. The short answer, however, is that index funds, gold, inflation-protected bonds, and government bonds are still generally safer than single stocks. This doesn't mean they will never decline, but it does offer a higher chance that the dips and the peaks will be less exaggerated. You should still consider these long-term investments, though, and at the moment experts are still urging investors to resist the urge to sell when in a falling market. The invasion of Ukraine, what it meant for the market. So, how has the war in Ukraine followed or bucked these trends? So far, it's been a mixed bag. I suspect when we look back, we'll see that many of the statistics from previous international conflicts and crises will be strikingly similar to the ones we see related to this war. However, it's hard to tell just what the overall outcome will be while the war is ongoing. The first thing to note is that while the current situation is the most extreme stage of the conflict so far, the Russo-Ukrainian war has been ongoing since February 2014. It really started with the invasion and annexation of Crimea on February 20th, 2014. Crimea is currently in Russian hands, and the invasion of mainland Ukraine in February 2022 essentially compounded existing tensions. The impact on the market was pretty substantial, which isn't surprising given the relatively weak economic position much of the world faced post-COVID. In March 2022, Time reported on the impact of the early stages of the war. The financial market was hit pretty quickly. Inflation hit a 40-year high in March 2022, and the S&P 500, that all-important market benchmark, had its most substantial drop since May 2020. In fact, in 2022 the S&P 500 index fund entered corrections for the first time in years, with concerns that a bear market would prevail. The U.S. recovered pretty quickly thanks to its large domestic economy and relative isolation from the conflict. Despite this, inflation continued to rise in the U.S. and Europe. The impact for index funds as a whole was decelerated growth or a fall in value despite certain individual stocks doing well. Those index funds and mutual funds that had a good stake in oil, gas, and other well-performing assets fared better, of course. The real question on everyone's mind is what the ongoing conflict means going forward and what we can expect from 2023. Ongoing impacts of the war in Ukraine. The continued conflict in Ukraine means that the small impacts, both on the market and in terms of human cost, are being compounded. The initial spike in oil and gas prices from an average of $80 a barrel to $120 a barrel settled, but the real-time costs are still impacting the consumer. This is felt more in Europe, of course, where Russian oil fed 50% of energy needs on average. Consumers across Europe and the UK are experiencing a spike in energy bills, food costs, and other daily living expenses, which means that many have pulled back on luxuries. This has and will likely continue to impact the tech market. Forbes reported a slump of 30% in 2022 as well as a dip of 35% in the Dow Jones Technology Index. While peaks and troughs are a normal part of the market, these exaggerated losses, firmly in a bear market territory, are linked in many ways to the Ukraine war. The increased cost of living that we previously talked about, compounded by inflation, and topped off with a drop in demand for non-essentials, has impacted the wider market. Property values have stagnated and started to fall in many places, and increased fuel costs have started to impact the automobile industry. The second-hand market has fared a little better, but this is expected when people are concerned about the cost of new cars. One of the biggest impacts of the war, however, has been a sharp drop in the Russian economy. Per capita, the Russian economy declined more severely and more quickly than most others, with Saudi Arabia being one of the few countries that have maintained growth during the period. The S&P 500 has experienced a series of dips with minor recoveries over the last few years, as have other index funds. The ongoing conflict is currently compounding this issue for one big reason: fear. How fear feeds market volatility. One of the least tangible yet most influential factors that can impact the value of stocks and index funds is fear. Uncertainty about the future, which is rife right now thanks to financial pressures and the Ukraine war, creates trends of panic selling in even the most robust markets. Since the invasion of Ukraine, the market has not been at its most robust, and that has made this fear a far more pressing concern. As people worry about how to feed themselves and house their families, investments have dropped in priority. More worryingly, fear about the state of the market and a possible crash has already caused isolated incidents of panic selling. As major movers like Amazon and Tesla experience losses, concern about the global financial market has spooked many investors. Of course, there are those who sell not because of panic, but to make ends meet. Using their investment portfolio to pay bills and stay afloat may be a short-term choice that comes with big losses, but there are those who have no choice. George Wong at Livewire has written a compelling article on the impact of fear on the market and the hazards of the action bias that it causes. He argued that fear of financial instability and loss of assets, all these things, activate our fight or flight instincts in the same way that physical danger does. This makes sense because losing our homes, our jobs, and our assets is equivalent to physical danger in a world where money means security. This fear and its connection to our instincts cloud our ability to make rational, fact-based decisions. Instead, we react to crises like the Ukraine war by thinking about our immediate safety. We start to condense our lives and pool our funds in case the market goes belly up. The reaction may be understandable, but the result can be disastrous both for our long-term financial health and the health of the market. Selling your shares in an index fund such as the S&P 500 in a falling market makes a personal loss. If enough people do this, however, it exacerbates the depression of the fund and, if the trend is sustained, the market as a whole. So, selling right now may not be the best choice. If you can avoid it, we would recommend that you do. Historical data suggests that the market and the value of index funds will recover given time. Give your long-term investments what they need to heal: time. While the war in Ukraine will continue to impact stocks, mutual funds, and other assets for the foreseeable future, there are some predictions for 2023 that might put your mind at ease. How will index funds fare in 2023? At the moment, we face a time of uncertainty. As the conflict in Europe drags out and the cost of our daily lives seems set to increase, it's only natural to worry that those rainy day funds will suffer. The hot topic for many investors right now is whether it's time to change strategy or even sell up. Selling in this market is probably the worst route to take right now, as we've said, but there are some predictions for the year ahead that you should be aware of. Firstly, you may be disappointed to hear that index funds are predicted to maintain relatively low performance. According to JP Morgan, the S&P 500 looks set to revisit the lows of 2022 in the first half of the year. However, there is also a high chance of a bounce back that you shouldn't discount. Even if the war drags on through 2023, which looks likely, the market seems ready to stabilize. This means that your index funds probably won't be market leaders, but they still offer the relatively lower risk levels that many investors prefer. Central banks are likely to have to cut interest rates on long-term loans and mortgages in the coming year, which should drive some recovery in asset values. There are even some whispers that a bull market will hit crude oil and gas prices in 2023, perhaps as a result of ongoing conflict and disruption to the supply of oil from Russia. One real threat to this, aside from the escalation of the conflict in Ukraine, is the rise in labor costs. With calls for wage increases across the board and the cost of transporting goods also trending upward, certain parts of your index fund could face troubled waters. Conclusion: should you change strategies? Macroeconomic issues like this may be out of the control of individual investors and fund managers, but at the moment it looks like maintaining course is really the best choice. Individual stocks offer the potential for outsized gains and losses, but index funds remain the safer choice for long-term investors who can afford to wait this out. Changing strategy now may not be the best choice for investors who have a good track record. However, there is something to be said for investing in a market that is experiencing a dip. Investing on the way down is a riskier strategy, but it is one that those with strong nerves can benefit from. What do you think? Will you be investing in stocks and index funds that have made losses recently, or will you wait out the storm with your current strategy in place?